and then you can step away.
Okay, let's try the income approach. Let's put it to work in a problem. If you're looking at the first one in your workbook, the problem starts out, a property has gross market rate income. Well, look, you might want to do yourself a favor. I typically use the word gross potential income to mean gross market rate income. So assume we're starting at gross potential income here, $56,000. And notice we didn't even make you work for it. We just simply gave it to you instead of telling you how many units and at what price. We gave it to you. Property has a gross market rate income of $56,000. Boom. Now, I highly recommend every time that you do one of these problems, you simply label the numbers. Gross potential income, in this particular case, notice as we move forward, vacancy and collection losses are estimated at 5%. Notice I told you vacancy is typically expressed as a percentage, in this case 5%. 5% of $56,000 looks like it's going to be about $2,800. Is that right?
Correct.
Okay. So in other words, you couldn't collect vacancy and credit loss. So 56,000 minus 2,800 looks like it's going to be $53,200. Mm-hmm. And do you remember what that is? Well, it was gross potential, but you can't collect potential. But after you lost vacancy and credit losses, this is your gross effective. This is the amount of money you actually touched. Gross effective income. Now, gross effective income is good, but you haven't started paying any bills yet. Now, notice the trick that we try to do to you in this particular problem. There's going to be the following expenses. There's going to be management fees. Well, can we subtract those as expenses? I think so. Management fees are legit expenses of the building. Maintenance and repairs, again, legitimate expense of the building. What was that? Maintenance. Okay. Maintenance. Depreciation. Now remember, when we're doing the operating statement, we don't talk about depreciation. And the next line, interest expense, we don't talk about that as well. That may have something to do with the way your capital is performing, but it doesn't have to do with the way that the building is performing. Okay? And then I look at the last line, repair reserves, sometimes referred to as replacement reserves. These are items that are set aside and treated as expenses so they can be used if there is a major problem that has to happen, that has to be repaired over a period of time. Replacing refrigerators, air conditioners, things like that. In this case, we're going to subtract it out as a cost of running this building. Okay, now let's take a look. $53,200 minus 2,000 minus 3,500 minus the 1,540 is going to be a total of how much?
1 second. 46,160.
46,160. So notice what we had here. We had gross effective income minus expenses equals, do you remember the word for that? Net operating income. And then finally, we're determining the value. Notice as we close out this question here, it says, what is the value of the property if the cap rate is 12.5%? So 46,160, I'm going to need some help with this, divided by 12.5%, and then you just have to trust your calculator. How much? Sorry.
369,280.
369,280. And what is that number? Well, this is the valuation chapter. So that is the value that we believe we're going to sell that property for. Now, listen, when I list that property, I may list it for 370 or I may list it for 360 or whatever. But using the income approach, this tells me about where I'm going to sell that property. Remember, every time that you do this, please say these words: gross potential minus vacancy and credit loss equals gross effective. Gross effective minus expenses equals net operating income. NOI divided by cap rate equals value. The reason is, sometimes we ask you a math question that's not a math question. Sometimes we ask you a math question that's just words. And the way we might ask you a question like this on the exam is we could say, what's the formula for net operating income? And the answer is going to be gross effective minus expensive. If we asked you what the formula was for gross effective, it would be gross potential minus vacancy credit loss. Do you see how we can make multiple questions off of that? There's your income approach.